bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the June 2nd, 2026 episode. Today's episode is a deep dive into the federal tax credit equity markets. In this episode, we're going to cover the following four tax credit equity markets: the long buzzing tax credit, both allocated and private activity bond tax credits. We're going to cover renewable energy tax credits, solar, wind, and many others. We'll cover the new markets tax credit, as well as the historic tax credit. Now, those of you on YouTube can see that to cover this topic, I'm being joined by four of my partners, which I do believe is a record number of guests for Tax Credit Tuesday. Now, alphabetical order, they're Brad Elphick, who is a partner in Novogradac's Metro Atlanta office; Tony Grappone, a partner in our Andover, Massachusetts office; Mike Kressig, partner in our St. Louis office; and Dirk Wallace, partner in the Dover, Ohio office. Now, across my four guests, we have expertise in all four of the tax equity markets that we're going to discuss over the course of today's episode. And let me also note, today's episode is part one of a two-part episode. Now, Dirk is joining me to lead the discussion on the long buzzing tax credit, Brad on the new markets tax credit, Tony on renewable energy tax credits, and Mike Kressig with respect to historic tax credits. As I mentioned, today's episode is part one, and today we're going to focus on the supply of tax credits across the various tax credit opportunities. I'll have each of my guests give a brief description of the credit, very, very brief, and then share a 5-year window at how many credits have been available the last couple of years and what their estimate is of the credits in their area in 2026, 2027, and 2028. Now, in addition to discussing the supply, both historical and projected, over a 5-year window, I'll have each of them also discuss who the typical investors are in the credits. And then I'll close this week's portion of the podcast with a estimate of the range of tax credit equity pricing among the various tax credits. Next week, in part two, we're going to focus on factors that affect tax credit equity demand. Now, in addition to the factors that affect tax credit equity demand, we're also going to review possible legislative or regulatory changes that could increase investor demand for various tax credits. As many of you have heard me say at many conferences, both Novogradac sponsored and others, everyone should be for increasing investor demand for tax credits because that's a win-win-win. It's a win for the investors. It's a win for the taxpayer where you get more resources for the same amount of tax cost, and then obviously a win for all those who are benefiting from the community development efforts that these tax credits support. So as you know, and as you've heard, we have a lot to discuss today, and we do have a lot of guests. So if you're ready, let's get started. Gentlemen, welcome back to Tax Credit Tuesday.
Great. Thanks, Mike.
So it's great to have all of you here. And as you know, each of you, since you've been on the podcast before, I usually will go and have each of you introduce yourself and describe the various services you provide to Novogradac clients. I don't want to do that this time. That might take a bit too long. But I would like each of you to quickly introduce yourself and share the practice areas at Novogradac that you work in. And I will start with Mike Kressig.
Thanks, Mike. I work primarily in 3 tax credit areas: historic tax credits, obviously, and also new markets and affordable housing or low-income housing tax credits. I also have a good deal of expertise with state tax credits and related syndication structures.
Great, thank you. I'm just going to go around the horn here, and I'll go to Tony next.
Thanks, Mike. Great to be here. Yeah, so I actually work in all of the 4 major federal tax credit programs. So affordable housing, historic tax credits, new markets, and of course, renewable energy. That being said, I spend most of my time working with the renewable energy sector.
Great, thank you. Brad.
Thanks, Mike. Happy to be here. and to be on a record-breaking podcast again. As expected, I focus most of my time on new market tax credits, but also have experience with the low-income housing tax credit and historic tax credit.
Thank you. Dirk.
Really? Yeah, great to be back. My primary tax credit that I work with is low-income housing tax credit. But as many people in the LIHTC world know, there's solar on a lot of properties. Some properties are historic that also have LIHTC. So there's a lot of crossover there. And I usually work with all three of those credits.
And I will also note that Dirk Wallace leads the low-income housing tax credit working group here at Novogradac. Brad leads the new market tax credit group here at Novogradac. And Tony Grappone helps lead the renewable energy tax credit working group here at Novogradac. So thank you for those efforts as well. Let's start our conversation by having each of you provide an overview of the particular tax credit that you're on the podcast for. And what I'd like you to do is give a very, very brief description of the credit or credits that you're here to talk about. Then I would like you to estimate the amount of tax credits that are newly minted every year that are marketed to investors. Now, I can't help but be an accountant here and give very specific instructions, just so we're talking comparably and so our listeners and viewers know what exactly we're saying. So I want you to describe the credit and then describe the volume of tax credits that I think of as being newly minted every year, and give an estimate for 2024 and 2025 as to how many newly minted credits, newly minted meaning that those are credits that have been put out in the market to raise tax credit equity against, and the credits could be claimed over some number of years, obviously, going forward. So what is your best estimate as to the size of the market of tax credits newly minted in 2024 and 2025? And then provide an estimate of what you think the market size will be in 2026, 2027, and 2028. And whenever I'm speaking at one of our conferences, I oftentimes will restate the size of the various credit markets, because I do think it's very insightful for those in the audience to know, are they pretty substantial relative to the market as a whole, or are they relatively small in terms of the overall market of tax credits? And with that, with those instructions, I think I'll start with you, Brad. If you wanted to explain a bit about what new market tax credits are, and then the size of the market.
Yeah, great. Thanks, Mike. And I appreciate the instructions, although I think I will deviate just a little bit once I explain kind of new market tax credit. So new market tax credit is a 7-year tax credit, 39%, that is spread over 7 years. And it was created to incentivize capital deployment in low-income communities for community development. So it was based upon the success of the low-income housing tax credit, which obviously addressed the affordable housing issue. And the need for new market tax credits was to supplement that and really invest in those similar communities to provide jobs and commercial businesses and rural investments and so forth. And so this credit has had a tremendous track record over the last 25 years. It was recently made permanent. If we had a confetti cannon, that's when I would cue that to go off. But it was made permanent last year, way overdue. And so that has really been a shot in the arm for the new market tax credit. And in addition to that, there was the largest round of awards made last year. So all of those things have been what we've been focused on here as it relates to new market tax credits. And so when you talk about it, unfortunately, the legislation did not say we're going to authorize this many tax credits. Instead, they talk about qualified equity investments, right? So when you see that the legislation to make the new market tax credit permanent is going to be $5 billion each year, that's not $5 billion in tax credits. That's $5 billion in allocation of essentially the amount of qualified equity investments that will be allowed. Now you take that $5 billion, you multiply it by 39%, and you get to about $2 billion in tax credits, just under $2 billion in tax credits that are authorized or minted, as you said. Before the new market tax credit was made permanent, there was a 5-year, $5 billion extension that we've been working with. And due to some delays in administering the rounds for those new market tax credits, the CDFI fund who administers the program combined the 24 and 25 round for a double round of $10 billion of allocation, not tax credits. So if you have $10 billion of allocation, there's $4 billion in tax credits. And that's what we've been seeing awarded as of the end of last year. And so when you're talking about the size of the market, 24 and 25, we were still using the $5 billion allocation that was around. So $5 billion in new market tax credit allocation was closed in each of those rounds. And then looking at 26, now that we have this $10 billion award, we've been trying to figure out how much allocation it will go up in 26. And while we've seen an increase, it may not have been the signs that we expected. We're probably expecting that $5 billion of annual activity to increase to probably $6 to $7 billion. And then the rest of that will carry over into 2027. 27 and 28 are authorized at $5 billion. And so we'd expect that number to fall back down to an annual amount of $5 billion in allocation that's closed annually. It's easy to talk about new market tax credits because it's a finite resource in that regard. So we're seeing that $1 billion each year, then account for the $10 billion increase. So you're having to get that out in 26 and 27 most likely, and then dropping back down to $5 billion.
And as you mentioned, those are the equity issuance amounts. So the actual tax credits themselves, $2 billion in 2024, $2 billion in 2025, $4 billion in 2026, albeit some of that $4 billion, the equity won't be raised in 2026, get raised in a later year, and then $2 billion and $2 billion thereafter, everything stays on schedule.
That's right.
Excellent. So next, Mike, I think I'll turn to you for the historic tax credit, in part because the historic tax credit is slightly less than the amount of new markets in terms of newly minted a year. And then we'll go to LIHTC and then renewables, because then we start dealing with multiples in terms of increased size of the equity markets. So take it away, Mike.
Sure. Thanks, Mike. So just a little bit about the credit. The federal historic tax credit has been around since the 1970s, so nearly 50 years now. It's a credit that is granted for the rehabilitation of historic buildings, and the credit amount is 20% of qualified rehabilitation expenditures, which are going to be most of the costs of a rehab. And that credit's taken over 5 years now, starting with the year that the credit's placed in service. In terms of market size, we do have data from the National Park Service that tells us the amount of credits that were generated as reported on final Park Service approvals. And so what we don't know, because not all of this is syndicated, on smaller deals, it's just really difficult to find syndication partners. So I would estimate that roughly 80% of these numbers actually get syndicated. But the numbers for 2024, it was $1.23 billion. I would note, you didn't ask for 2023, but 2023 was $1.76 billion. It was a big drop off from 23 to 24 for a variety of reasons, having to do in large part due to the increases in interest rates, construction cost inflation, et cetera. And then in 2025, it rebounded to $1.73 billion. So back close to the 2023 numbers. I am very bullish for 2026, and I base that on a few factors. One is that the number of preliminary applications that were approved, the Part 2s, were very, very high for the last 3 years. Now, that doesn't always translate. If the economic conditions aren't great, those deals may not pencil out, but that's one factor that's encouraging. The other thing I'm basing it on is just anecdotally what we are seeing at Novogradac in terms of our forecast structuring services is up about 30% year to date, which tells me that there's a lot of activity out there in the marketplace. So I'm going to be bullish, and I'm going to say we're going to be at $2 billion for 26. And I think some of that momentum will carry into 27 because these are reports that come out at the end. So the deals that are being reported on in 27 will be closing in 25 and 26. So I'm going to bump that up to 2.2 billion. And then it gets really murky after that because the historic credit, more than any of the other credits we're talking about today, is really tied to macroeconomic factors, and in particular, the availability of debt and interest rate costs, also to a fair degree, construction cost inflation. So I guess I'll be optimistic and say 2.3 billion in 2028, but my 2028 prognostication is pretty sketchy.
Yeah, not as easy as Brad's.
Yeah.
Right.
Obviously, that's because, as Mike points out, the historic tax credit is an as-of-right credit. You don't need to apply to get an allocation of the credits. You have to go through the Park Service to get approval of the work that you do. Right? You don't have to apply for the credit. The same thing with renewables. Renewables is an as-of-right credit for the most part, 99%, 98%. There's a few pieces that are you have to apply for in terms of adders and the like. And then also LIHTC, long-standing tax credits, of course, is allocated either directly to the 9% credit or indirectly to private activity bonds, which is a segue into Dirk to say something briefly about the long-standing tax credit and what it is. And as we all know, we are celebrating 40 years this October of the creation of the long-standing tax credit. Take it away, Dirk.
Great. Thanks, Mike. Yeah, I will try to be brief because we have a 8-hour 101. So I'll try to do it in 30 seconds here.
We will link to that in the show notes.
Right. Yeah. So the loan closing tax credit, or the LIHTC, it's an expenditure-based credit. So you're getting the credit based on eligible construction costs, which there's another 3-hour webinar on eligible construction costs. And really, you take those construction costs and multiply them by percent or 4%, as Mike alluded to. The 9% credit, per capita credit, it's at $3.41 for 2026. That increases each year by inflation. So the amount of available credits will increase each year on that per capita amount. The 4% credit, that's linked to taxes on private activity bonds. The per capita amount for private activity bonds is $135 per capita. Now that doesn't all go to housing, so it's not a huge difference between $3 versus the $135, but it's still also the 4% credit is tied to private activity bonds. The credit's claimed over a 10-year period. There's a 15-year compliance period, so we typically see LIHTC transactions have a 15-year or 15 to 17-year life, just depending on when the investor gets out. So really, in terms of the market, in 2024, we saw about 34 billion of tax credits. The 9% credit was maybe close to 12 billion of that, with the 4% credit making up the large difference there, almost double the 9%. In 2025, it's probably going to come in maybe right around that 34 billion. We had the lowering of the 50% test, which is a bond test, lowering that to 25%. And there were states that were giving incentives for developments to wait until 2026. Some developments were just waiting because maybe their deals penciled out better in 2026 than 2025. We are seeing, or we did see in 2025, a levelness or a steadiness of the tax credits that were available between 24 and 25. If I was projecting over the next 3 years, I think by the time we get to 2028, I think we will be in that 45 to 50 billion range. It's just going to take a little bit of time to get there. Some states were a little slow to get their policies out. Some states were very quick, and some states had them out in 2025. But we're still seeing some states, it's June of 26, so their 25% test policy out. So 2026, we're definitely seeing a tick. 27, we'll continue to see an increase there. And I think by the time we get to about 2 to 3 years out in 2028, we will see about 45 to 50 billion and be newly minted credits that would be available in 2028.
Thank you for that, Dirk. And just to unpack a little bit more of why 2025, we're thinking and estimating we've got the same as 2024, is there are a number of jurisdictions, California, probably the most notably, took some of their bond allocation and incentivized developers to return it and get it the following year. And by virtue of the state carrying that volume cap over from 2025 to 2026, those bonds would be subject to a 25% test versus 50% test. So you could get more housing. So to a certain extent, there was less awarded and newly minted in 2025. So close to double of that could be newly minted in 2026, which then also creates the choppiness of 2026 being a little bit larger. Otherwise it would be because of that. But then as Dirk pointed out, a number of states have been slower to come up with their rules around the 25% test and the like, or they just haven't made any changes and they won't make changes till next year, such that it's going to be a bit choppy or lumpy in terms of the ups and downs between now and 2028 as processes are working through the system. And I do think Dirk focusing on 2028 that's when I think there'll be more normalizing of the LIHTC market in terms of the volume. And until then, the lowering of the 50% test, the 25% test has to get worked through the system. But with that, Tony, talk to us about the renewable energy tax credit market.
Okay, great. Thanks. So when we're thinking about renewable energy tax credits, we're really talking about two different types of tax credits. You have either a PTC, production tax credit, or you have an ITC, which is an investment tax credit. The investment tax credit is similar to the historic credit and the low-income housing credit in the sense that the investment tax credit for renewable energy is a percentage of your eligible construction costs. Okay. So the tax credit, the ITC, is meant to help subsidize and offset the cost of construction to build the power plant. The PTC works very differently. The PTC is a production-based credit, and you earn that credit over, say, a 10-year period, and you earn the credit based off of producing clean energy, usually electricity. So if you produce clean electricity and sell it to a third party, that qualifies for a production tax credit. So you can see how the two different credits are just very different. And so for the production tax credit, that can be for anything from producing energy, electricity, or even producing and manufacturing clean energy types of components. So you have an advanced manufacturing credit as well. The production tax credits are covered for the most part under Section 45 of the Internal Revenue Code, and the investment tax credit is covered under Section 48. The investment tax credit can vary in terms of its percentage. Most people like to think of the investment tax credit as having a base credit percentage of, say, 30%. However, you can get adders that increase that percentage. You can get adders for things like qualifying for what's called domestic content. That means you're basically buying a minimum percentage of your components from manufacturers that are based right here in the US. If you can meet the domestic content criteria, you can get an additional 10%. So now you went from 30% to 40%. If the facility happens to be located in a energy community, that can qualify for an additional 10% adder. So now you're at a 50% ITC. There's also what's known as a low-income community adder. Like you touched on that earlier. That's the one aspect of the renewable energy credits that's a competitive credit, not an as-of right type of credit, but you have to actually apply and get an allocation of that credit. But anyway, if you meet the criteria for the low-income community adder, you could get another 10% or even potentially a 70%. Theoretically, with an ITC, you could get theoretically, I say, you could potentially get a credit percentage as high as 70%. I've never seen that in practice. What you're more apt to see in practice is a 30% credit plus maybe a domestic content and or energy community is the most common mix of credits and adders we see. Those same types of adder percentages also apply to the PTC. So if you're doing a production tax credit deal and you're in an energy community or domestic content, you qualify for adders as there as well. The PTC is over a 10-year period usually. And with the ITC, that's a one-time credit like historic. You place your facility in service, and that's where you earn 100% of your ITC and claim it in that year. The ITC is subject to a 5-year recapture period. The PTC is not subject to a 5-year recapture period. Because of that, sometimes that helps to create more demand for the PTC just because of the lower recapture risk. That being said, we tend to see more ITC transactions in the marketplace. All right, so in terms of market size, here's an interesting, you asked for 2024 through 2028, but I got to go back to pre-2023, okay? Because before the Inflation Reduction Act came out, the renewable energy market was a sub-$20 billion market. When the Inflation Reduction Act was passed, it allowed for the concept of tax credit transferability. And tax credit transferability for renewable energy credits has caused just a huge increase to the market of renewable energies. For example, pre-IRA, so we're talking pre-2023 or 2022 even, the renewable energy market was sub 20 billion. In 2024, now you get 2 years of IRA under your belt, you're already at a $50 billion renewable energy market size. Last year, 2025, it was around a $60 billion market. We think it'll be close to 70 billion in 2026, another 10 billion in 2027, maybe even more than that. There are some people who are particularly bullish who are estimating the market could be 90 billion, maybe even upwards to $100 billion by 2028. And so I hear that some of these folks talk about these really bullish estimates. I tend to be pretty conservative in nature, and I always think, oh, there's no way we're going to get to that growth. And then you get to the next year and you look back, and the bullish estimators tend to be right here. So I wouldn't be surprised if things continue to go as they have in recent years. I wouldn't be surprised if the market reaches a $100 billion market size by 2028.
Excellent. Thank you for that. And well, maybe you should say something about the expiration of solar and wind and when you think there might be a drop off based upon the expiration of solar and wind.
Great. Appreciate that. So if you have a wind and solar project and you do not start construction on or before July 4th of 2026, then you'd have to get that wind or solar project placed in service before the end of 2027 in order to remain eligible for tax credits. Okay, so if you start construction on or before July 4th, then your place in service deadline extends out to as long as 2030. And so reach out to us. We help people understand how to start construction if you think you're in a situation where you need to start construction really soon to extend your place in service deadline. But if you can't, whatever, you can't start construction before July 4th, just note that for solar and wind, if you start construction after July 4th, you got to get the facility placed in service before the end of 2027. Look, people talk about this all the time. What they don't realize is I've been working in renewable energy since 2006. Renewable energy tax credits have always been on a start and stop timeline. Generally speaking, there's been a bit of a short runway for renewable energy tax credits. It wasn't until they passed the Inflation Reduction Act that people just thought of the renewable energy credits as having this really long runway. The runway that was provided for in the Inflation Reduction Act, that was the anomaly. The fact that we were back to a start and stop timeline is kind of the way it's always been. But we have faith. Okay, we're optimists. We're hoping that we'll eventually get an extension and renewed timeline of wind and solar credits.
Well, like we say at our renewable energy conferences, and I observe all the time, there's 2 congressional elections and 1 presidential election, but then now and that expiration date. And a lot can happen over 3 congressional elections and 1 presidential election.
Mike, I was at a disadvantage by going first here, and I'm a little bit insecure after hearing Tony's numbers of how big renewable energy is going to be compared
You change
to
your estimates?
new markets. And so I want to add a caveat to the predictions that the predictions are based on current law. And it's my intention that the current law does not remain the same for new market tax credits and that the allocation size grows from 5 billion to something much larger. So I want to say I'm bullish on that happening by 2028. And so hopefully those numbers will not be locked into what they are today.
And maybe a nice summary of all of this. I think a bigger point is what did we just unravel? That by 2028, you could have somewhere around 130 to 140 billion of total aggregate tax credits. Okay. So it speaks to the sort of like the size and just the dynamic nature of this industry. And whether you're investing into historic properties or you like the new markets program for low income housing and renewable energy, there are credit programs out there that do a lot of good and provide decent returns too for participants.
Tony, I would add to that, that's only the federal credits. And in the last 10 years, we've seen a significant increase in the number of states that are offering state credits, particularly in historic and LIHTC.
Indeed.
Yeah, I think we're up to maybe 25, 27 states now that have a state LIHTC. And it seems like every time I look, the numbers increasing.
Yeah. They're great programs. I love talking to new investors, folks who are trying to enter the space. And sometimes they have experience in, say, new markets or historic or affordable housing, and maybe they're looking at renewable energy for the first time. And they're asking me, what do I think? Which one's better? And I don't think there's one that's better per se. They're all great. One thing that's fantastic about the program is, in my experience, based on what I've seen, the recapture rates, they tend to be very, very low. So the success of the credit programs has been excellent over the years. And, depending on your needs and what your business objectives are, it's great to know that there's a lot of different community development style programs to invest in.
And that's a good segue into our next episode, which we're not going to end this yet. But in terms of the next episode, we will go into a lot of these factors in terms of what makes certain tax credits more desirous among certain groups of investors. We'll do a real deep dive into that. But as a transition in this episode to the next episode, I did want to have each of you discuss equity pricing in the area. And I will note to our audience that the 2028, 140, 150 billion of annual newly minted credits, that is newly minted that will then be claimed over up to 10 plus years once the facilities get placed in service. So it's not as if there's that many credits that year. It's the amount that would be claimed over a time period depending on which credit it is. And then I also would note that as we're thinking about equity pricing, there are a number of factors that go into equity pricing. Once again, we'll talk about it more next episode, but I'll just say that two very important factors is the credit taxable or not, in the sense of is there a basis adjustment, and what's the term of the credit? Over what period of time are you claiming credits? Obviously, the longer the period of time you're claiming credits, the less present value. To the extent that it's taxable, meaning there's a basis adjustment, then obviously on an after-tax basis, that's not quite as valuable. But there's also a host of other factors, which, like I said, we'll do a deeper dive in the next episode. But with that as the groundwork, I'm actually going to not select one of you. I'm going to ask one of you to volunteer to go first. And don't all jump in at once.
I can start us off, the loan housing tax credit. The loan housing tax credit, we're seeing somewhat of downward pressure on pricing. Essentially, whenever we talk about LIHTC pricing, because credits have different prices based on a lot of characteristics of the properties and location.
Let me just interject here. For everything we're talking about here, for the audience, know that we're going to be talking about averages and examples of different types, but know that there is a wider range of equity pricing, even within the various tax credits. And once again, on the next episode, we'll give you some of the reasons why that's the case. Back to you, Dirk.
Yeah, and I think we're seeing a very wide range in LIHTC, because when you talk about pricing in, say, the low 80s, you may have some properties that are still pushing 90 cents that are in larger CRA markets. I've seen some properties in the low 70s, 90, kind of average into that 80s. But I think there's certain states too that offer incentives to investors. For example, Tennessee, where there's a state component to investing in LIHTC, where that might drive up the price because there's more competition there for the federal credit. So when we're talking about credits, I think we're now talking about 4% separation as well, where maybe a few years ago, you were just talking about one price for both. We're starting to see a little bit of a separation where 9% tax credit properties are getting a little bit higher pricing than 4%. We did see the return of bonus depreciation, which increases earlier losses. And, that had some impact. Again, when you look at investors, not all investors are the same. Some prefer losses up front. Some don't prefer as many losses, but they're really in for the credits. So a long-winded way to say the average credit pricing is looking like it's in that low 80s, low 80 cents for the federal credit. But again, there's a wide range, between 70 and 90 cents per credit.
And we will include a link in our show notes to the web page that we have where we track equity pricing for 9s and 4s, month trailing average, and we have some regional data as well. So we'll share that link for those viewers that want to get a little bit more detail on equity pricing for the loan housing tax credit. Next, let's go to you, Mr. Kressig.
Sure. So I would say at a high level, the range of pricing for historics is similar to LIHTC. It's probably from the mid to upper 60s on small deals to low 90s on deals that kind of check every box. And, if you took a midpoint where most of the deals that are syndicated fall, it's probably in the low to mid 80s. I would observe that the HTC, again, it is a taxable credit, so there is a back-end tax, unlike LIHTC, a basis reduction that effectively gets recaptured when the investor exits. It's also claimed over 5 years, with the first year being a year or two after a closing, and that 20% of the investor's capital has to go in prior to construction completion, but in practice, that happens at closing. So those factors affect the pricing as well.
And I think of that, certainly in addition to my term of the credit, as well as the taxability of the credit, I'd probably also throw in the timing as to when you make your capital contributions in terms of the identified equity price, which just gets back to the notion that it's interesting cocktail conversation to be talking about the cents per dollar, but you could be getting lower cents per dollar and getting more economic value depending on these other factors. Brad, new market tax credits.
Yeah. So the new market tax credit's a 7-year credit. It's taxable. So there is a discount due to that. We have been tracking this, and I will say that stability and permanency, or at least predictability, has had a strong impact on stabilizing pricing. And I would say that over the last 3 years, pricing has been about the same in the new market tax credit. It's been on average somewhere between 79 and 80 cents. I mean, that tight. And the floor and the ceiling in that price range has actually started to compress as well. We used to see more of a spread. Even just last year, the floor was 75 cents is what we saw on the low end, and then low 80-cent range. We're seeing that this year compress closer to 80 cents. And so the floors come up a little bit. CRA will always impact pricing because the investors are typically financial institutions. So you may see some odd pricing depending upon that. But one of the things that has been interesting 2 years ago, when the concept of a double round of $10 billion of allocation was first discussed, there was the concern that the pricing would go down because you're increasing the amount of supply. And we'll talk about some of those pressures more on our next episode. But I think because of the runway between when those first discussions happened and when the awards were actually made, the business strategy and investment strategy of investors has really been able to plan for that. And it hasn't had that much of an impact on pricing as maybe was being predicted 2 years ago. And so that pricing has been much more stable than I think people thought it would be in 2026. So that's been good for the industry.
Great. Thank you for that, Brad. Now, Tony, bring us home. Talking about
All right.
energy tax credits.
Perfect. All right. Before I do that, though, I just want to ask Brad, Dirk, and Mike just one question. The pricing that you quoted, is that for just the credits, or does that include the tax depreciation benefits that the investor would be able to use?
Yeah, that's all in for LIHTC. Yeah, that's the all in price.
And the reason I ask is because in renewables, you've got the all-in pricing if it's a partnership where you have an investor, or you have the transferability pricing if they're literally just buying the tax credit itself. All right. So I just want to make sure.
Yeah, Tony, on the historics, it's because of the fact that it's a taxable credit, you're really just renting losses, and it's for a relatively short time frame. So it doesn't really have a big impact.
Okay, great.
Yeah. And for new markets, it's all in just because there really isn't a loss component like there is for LIHTC and historics. It's mainly just the tax credit benefit itself.
Great. And when we say the credit's taxable, that doesn't mean it's taxable to the investor or whatever. It means it's like there's the basis of the property that's generating the credit is reduced by the amount of the credit, right? That's what we're saying.
That's right. The basis gets reduced.
Yeah.
So the investor ends up on the exit, having to recapture and recognize some amount of gain. And that would be for the new markets and historic. And as you'll talk about in a moment, renewables, 50%. But with LIHTC, LIHTC is not a taxable credit. So it gets the benefit of being able to have losses without recapture of the losses, except to the extent losses are in excess of the amount that you invest in the property net of cash flow.
Okay, great. All right. So in that same kind of comparison, I'll talk about a partnership, or a classic tax equity partnership style. Okay. So with the ITC, that would be considered a taxable credit, because with the ITC, you have to reduce the basis of your depreciable property by 50% of the amount of the ITC. Okay. Now, if we're talking about a PTC, there's no basis reduction there. So I guess we don't have a taxable credit with the PTC scenario. I'm going to talk about it in the context of a partnership flip. In renewable energy, you have several different types of ownership structures. You might have a sale leaseback, inverted lease, pref equity structure, et cetera, et cetera. The most common structure is a partnership flip. So I'm going to talk about the pricing with respect to that structure, because if you were to get into the other structures, you have a different kind of pricing discussion around each structure. So I'll just try to keep it to the most common structure you see in the marketplace, partnership flip. All right. So I got to go with the high-low range of pricing for what an investor would contribute to a partnership. to get credits, depreciation benefits, and some relatively de minimis cash flow. We're talking about the fixed flip structure. And the low to high pricing there is probably in the $2 to $12 range. Okay. And for that, the typical structure involves the investor getting 99% of the tax credits and then essentially 99% of the tax depreciation benefits, along with a per annual priority return, which is something you're apt to see also in the historic tax credit market. And then we're talking about an ITC deal here. At the end of the 5-year ITC recapture period, there's usually a ownership flip mechanism that takes place immediately following the flip. A call option period ensues, and during the call option period, the general partner or one of their affiliates has the option to buy out the investor for whatever the investor's fair market value of their ownership interest is as of that point in time. Okay, so the $2 to $12 is for the credits, depreciation benefits, the annual priority return, plus the call option payment for them to go away.
Great. Thank you for that, Tony. And I'll just note, I'm sure our audience is saying that's pretty different. Love the tax credit pricing and the historic tax credit pricing and the new market tax credit pricing. And I'll just note at a super high level for our audience, and let others of you comment on it, that if you're wondering why the price is that much higher, I would say that there's probably 3 factors that cause renewables to be, the example that you gave, the ITC or higher, is one, and probably the most significant, is you get the credit when you place the property in service, 100% of the credit. So your capital is coming back really quickly from when you put it in to when you get the tax credit. And then in addition to that, you're getting losses, half of which won't be recaptured because you get losses against the amount that you paid for the credit. And much like with LIHTC, you get 100% of the losses on your equity investment. Here it's 50%, but you get that as a permanent savings. And then you also throw in some cash flow. So the present value of the cash flow, present value of the tax losses, the portion that'll get recaptured along with the present value of the credit itself, get to that sort of number. LIHTC, you claim over a longer period of time. There's not much in the way of expected cash flow, but you do get the losses or do all the present value discounting. That's how you get to where we're roughly at. So with that, Tony, please elaborate, clarify.
Yeah, no, that's a great distinguisher. I'm glad you pointed that out. And the big difference in renewable energy versus these other deals is that cash flow that the renewable energy partnership has to give to the investor. Okay. And so if you were to unpack the investor's pricing and look at how much they're paying for the cash flow, it's around 10 cents. Okay.
Yep.
Or more sometimes. So then if you take that out, now these other credit programs like LIHTC, historic, and new markets, you're not really sharing cash flow with the investor at all. Okay. Or not nearly as much. And so if you stripped out the cash flow portion of the pricing, I'd say the pricing in renewable energy is probably more like, mid to upper 80s to mid to upper 90s.
No, thank you for that. And we'll go into more detail in the next episode on that. I do want to bring this to a close. So I do want to have each of you discuss other resources that our audience could be turning to between now and the next podcast. I'll start with you, Dirk.
Yeah, so as Mike mentioned, I head up the tax credit working group. We do have a lot of resources on our website there about various letters. Also on our website, as we mentioned, there's our pricing data that you can look at, as well as a bunch of other educational resources on there. So yeah, I guess I'm referring everyone to the website.
Great. Thank you. Mike Kressig.
Well, likewise, I would refer people to the website. They can also reach out to me directly, and my contact information is in the show notes, I believe.
Yes.
And also wanted to give a quick plug for the fact that the Historic Tax Credit Conference this year will be in my hometown of St. Louis in October.
Great. Thank you for that. Tony.
Great. Contact me directly. Go to the firm's website. We've got the Renewable Energy Working Group. And then in November, we have our Renewable Energy Conference in Washington, D.C.
And Brad, we'll be seeing you in DC next week. So I think you might be mentioning the New Market Tax Credit Conference.
We will. By the time this podcast airs, if you're not already registered, you'll only have a day or two to get to DC for our conference. But we hope you'll already be there, and we look forward to seeing you. If not, you can always join us in New Orleans in October, the 22nd and 23rd. As the rest said, we also have the New Market Tax Credit Working Group. You found this podcast, you're probably already familiar with the resources on our website, but if not, it's a great tool there, and you can always contact me as well.
And let me also note that we do also have 2 upcoming local housing tax credit conferences, one in Honolulu, Hawaii, for our 3rd year there, in Nashville, Tennessee. So we do hope that you'll join us at one or more of these conferences. And if you do, please do make a point of coming up to me and other guests on this show and saying hello. It's always great to meet our audience in person at these events. So let me thank all my guests for participating in this discussion today of Tax Credit Tuesday of the equity markets as part 1 of a 2-part episode. I'm going to skip our normal off mic section given the time. So I'll just say a few words to our audience. Let me just say, if you got value out of today's episode, I'm going to share with you 4 ways to support Tax Credit Tuesday and help more industry colleagues discover these insights. First, do subscribe to Tax Credit Tuesday on all your favorite podcast platforms. We're on YouTube, Spotify, and many others. Second, please visit the show notes to connect with my guests and explore additional resources from the day's discussion. Third, please do share this episode with a colleague or colleagues to help them get access to all the great information we share here on Tax Credit Tuesday. And fourth, please share any ideas you have for future episodes, or if you have any questions, please email them to contact@novoco.com. So once again, thank you all for being on the podcast this week. And to my audience, tune in next week for the rest of my conversation with Brad Elphick, Tony Grappone, Mike Kressig, and Dirk Wallace. And as I mentioned in that episode, we're going to focus on factors that affect equity pricing and, maybe even more importantly, possible legislative or regulatory approaches that could positively affect tax credit equity pricing. I do hope you'll come back next week for that episode with my guests. Until then, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.